Four-day winning streak on the Nasdaq right now, down 0.5%. Even with the bond market doing what it's been doing, this equity market month to date is doing pretty well. Switch up the board and get to treasuries. Yields shaping up as follows on a 10-year. Going into payrolls on Friday. Yields inching a little bit higher again. 240, 220 on 10s, up 3 basis points. The euro finding some strength in the face of the highest inflation print we've seen since the 90s from Germany. Euro dollar 111.42. Let's call it 111.43. Up 0.5%. And crude rallying now, up by more than 3% to 107.82. Yesterday, some hopes for a diplomatic breakthrough, and this morning, seemingly everyone throwing cold water on that. In the session right now, about 30 seconds in, we decline 0.25%. Turned yesterday upside down for energy, yesterday morning anyway. Crude is higher, energy's higher. In the equity market, up 0.6%. Consumer discretionary is down about 0.5%. For your movers at the opening bell, here's Abby.
John, let's start and stick with that energy story. And we are talking about most of the energy names higher at this point, as you were just mentioning, energy, the best sector. In particular, BP right now up more than 1% in sympathy with oil. WTI crude back above $108 per barrel. Rio Tinto also higher, so you see a little bit of a rebound for materials. Micron, they put up a really nice beat, they put up a beat and strong outlook, giving the stock a nice boost up about 5%. Chewy, on the other hand, down 15%. This, of course, after they put up a mixed quarter. The view for sales not great, and there is a 30% bearish short interest. Those bears very happy today, John, with Chewy down 16%.
Abby, thank you. A key feature of the rally through the month so far has been the massive moves we've seen out of big tech. Ed Ludlow on the West Coast, driving you through some of the price action. Morning, Ed.
Yeah, morning. I'm actually going to start with oil, John, up 4% on WTI West Texas Intermediate crude, up to about $108 per barrel. It's interesting, there's signs that production in Russia has been wavering, even though we had such optimism on Tuesday around talks with Ukraine, and that would boost supply. Also, the Bloomberg Commodity Index down by around 2 percentage points, snapping basically 2 straight days of 2% gains. There's a change in that equation, right? You look how that's playing out in the equity markets and investors trying to position themselves. Energy, materials, where do you put yourself in this market when you're not sure on the long-term outlook for the supply? The materials stocks up around 0.2%, energy stocks down 1.3%. But yes, back to big tech, because you know that's where I focus. We've had this broad rally, right? And the mega caps, the tech stocks have been the mainstay of that. The Nasdaq, even though we're a little softer on Wednesday, seems a little bit unstoppable, but there are warning signs that the gains of the past 2 weeks has hallmarks essentially of this bear market rally, despite that sustained momentum. Mega caps, you look at the value we've added across the biggest technology stocks, $1.5 trillion over the last 10 days or so. What derails that? What is it that the market is actually tracking? What is the psychology here? You and I have discussed over the first 3 days of this week how not all tech stocks are created equally, right? We're worried about the outlook for higher rates than the Fed. But there is this move, it seems, into higher quality growth stocks. But what I would say, looking across the NYSE FANG Plus Index this Wednesday morning, Apple, John, up for a 12 straight day, just up 0.2%, on course, of course, for that all-time record winning streak, but the rest of mega caps a little softer this Wednesday morning.
What a run it's been. Ed, thank you. We'll catch up with you a little bit later. Ed Ludlow there on the West Coast. The Nasdaq 100 entering today at a 12-week high. Goldman say this: leverage investors have participated by aggressively reducing their equity exposure. They go on to say, short covering by these participants helps to explain why some of the longest duration equities have recently risen sharply in the face of rising interest rates and a more hawkish Fed. I'm pleased to say the man behind the note joins us now, David Kostin of Goldman. David, always good to catch up, buddy. Let's start right there. Yields are flying. They've been surging through March. We've got hawks all over the place and big tech has rallied. Walk me through piece by piece why this has been happening from your perspective.
Well, there's a concern about a upcoming recession. It's not the Goldman Sachs economic forecast, but certainly in the minds of many portfolio managers, that is a increasing risk. And that is one of the reasons why their attractiveness of some of the largest technology stocks and some of the more durable earnings companies in many different sectors, but we'll focus on tech for just a minute. And I believe that is a key kind of underpinning thesis for why the stocks have done well. We are about to embark on the first quarter earnings season that will kick off around April 11th or so. And I believe that there's going to be a significant number of negative earnings surprises. In fact, you probably get a large number of pre-announcements in the coming weeks just before the earnings season. The reason I believe that is that it's been a particularly difficult quarter from a operational point of view for management. So you think about the first month of the year in January was largely overshadowed by Omicron, and then you had the higher rates that really kicked in February, and then you have most recently the tragedy in the war in Ukraine. So you have these events that have really impeded a lot of sales for a lot of companies, and I think managements have been reluctant to give guidance, understandably, because things are really swiftly moving. And so I think that's a question on the prospect for earnings. Jonathan, the earnings revisions have been negative for most sectors in the market in the last month, and frankly, they've been pretty tepid for the full year in the first 3 months. But the most recent kind of activity has been downward earnings revisions, and I think that is a concern about on the part of many portfolio managers, and which companies have the probability of actually delivering on expectations. And therefore, a lot of the technology companies are perceived as having more stable prospects of earnings.
Do you share that view, though, just on tech? I mean, you've got this view that we're going to get some earnings warnings here, David. Where do you think those warnings will be concentrated?
Well, I think you want to, then I feel very strongly you want to break the technology sector into a couple of pieces. One is profitable and growing companies, and there's a large number of unprofitable companies that are still growing their revenues and forecast to grow revenues quite sharply. Jonathan, those two groups of stocks basically trade at the same valuation level, around 7 times enterprise value to sales. That is sort of inconsistent in terms of a normal valuation, well-ordered market. Normally, if you have corporations and bunch of companies that are growing at 20% top line with very high margins, say north or above 20%, and then have a group of stocks where they're also growing rapidly, but they're very thin margins, perhaps losing money, those should not generally trade at the same level of valuation. And therefore, I think there's more risk in some areas in technology. Where you're likely to get some of the weaknesses, probably in some of the consumer discretionary oriented and facing companies, some of the consumer staples areas where the consumer has been is challenged in this environment. So we think about where that's weak expectations on profit growth, that's an area that we would be concerned about. Obviously, another area is some of the companies that have a lot of revenue exposure towards Europe, as compared with companies that are primarily domestically facing. That's another kind of split in the market in terms of investor focus, which I happen to be focused on a lot with conversations. Dividends would be another area of focus. Those companies that have both increased their dividends already since the start of the year and are forecast to have kind of increased dividends hikes this year generally offer some ballast and some insulation to some of the broader macro issues of a decelerating economy. I think the general environment is you have weakening profit growth, and you have a higher interest rate environment. And in my calculations, with a 10-year U.S. Treasury yield, nominal yields at around 2.7% at the end of this year, and the economic forecast that we're assuming, which is deceleration the rest of this year, that supports around 4,700 level for the S&P 500, which is very limited upside. Yeah. Whereas in contrast, if you had a recession, you'd be closer to, say, 3,600, much lower. I think the distribution of risks right now is more to the downside than the upside, given that combination I just mentioned.
Interesting. Yeah. Well, I'll come back to the rates call in just a moment.
Point,
you mentioned the consumer. I think that issue is multifaceted because going through your research as well, you also talk about the household allocation to equities today,
the aftermarket,
relative to recent history. And David, I wonder if the consumer makes you worried about consumer spending, does it also make you worried about household allocation to equities, which has been supportive?
Let's not forget China's property sector is still an issue.
Well, it's a situation from an asset allocation point of view that is not just for the consumers. If we kind of expand that for a moment to think, in addition to mutual funds and pension funds and foreign investors, collectively, those categories, they control or they own or they represent about 90% of the ownership of the U.S. stock market. Obviously, a major portion of that, about 38%, is comprised of consumers. Those entities have around 50% of their asset allocation to equities, about 20% to bonds, and around 12% to cash, balance being gold and commodities, things like that. But those three major categories, where else is one going to be allocating money in this environment? With the bond yield forecast that we have at Goldman Sachs, rising rates means it's a real headwind for getting a positive return in the fixed income market. Cash likely to continue to get a better return as the Fed continues to hike rates. But in the equity market, broadly speaking, there's a bias in favor of that from a risk premium point of view. So at the end of the day, we think about the opportunity set in equities, modest upside, admittedly. I think relatively, also some downside. Obviously, there's distribution of some risks.
Sure.
But the balance sheets of a lot of companies are very, very strong, and they're buying back a lot of stock, which is the other supportive attribute of equities at this point.
David, not every research
they've
department
already
is
done
fully
a lot of
aligned
that
between
already.
rates, the economists, and the equity strategists. But I want to pick on your rate strategists just for a moment. They've got curve inversion year-end this year, year-end next year, and year-end the year after. David, that's a very strange dynamic to have that consistently through the next 2-3 years. I want to understand what that means to you from your perspective, even if you don't agree with it. And you can say if you do or you don't. But even if you don't, I want to understand if that's going to be the case in rates, what does that mean for stocks?
Well, it means that the trajectory of increase in the level of the market or decrease in the market is going to be a function of profit growth. It's incumbent upon companies to deliver better earnings, probably through margins. And the reason for that, Jonathan, is the idea of a decelerating economy means that the challenge for companies is to generate revenue growth as the economy is slowing. So therefore, there's much more
while they're trying
focus
to raise
on
taxes.
the margin structure. And what you are seeing now, and what you are likely to continue to see this year, is corporate spinoffs. That's likely to be the major corporate finance development, in my opinion, as you see the balance of 2022 continue, because corporations are thinking about ways to improve their margins and create value for shareholders in an environment where the economy is decelerating, getting higher sales is more difficult. Now, coming back to your question about rates, the idea of valuation headwinds, that's basically what a higher rate environment is going to entail. You've got higher short rates, you've got higher long rates, you have the yield curve that is basically bear flattener in terms of the trajectory and reshaping of the curve. That's a more challenging environment for equities. The companies that are buying back a lot of stock likely to be in the area that outperforms in that case. Companies that are paying dividends, also a way of thinking about that. The overall index, Jonathan, is likely to be more shallower trajectory of
dividend value
upward,
stocks.
generally speaking, upward move in the equity market, because the economy generally is still rising.
For equity
we are not
allocation.
anticipating a recession, although the a inverted yield curve would suggest that is a
by the way,
risk.
the yield curve inverted yesterday.
One of the reasons, many reasons why, but that's a particularly intermediate risk why investors are so focused in this area.
Can I finish on this question, because I know
Intermediate.
Are you losing conviction on your year-end price target? Just going through this conversation with you right now, how high is your conviction on that call right now at 4,700?
Well, there are a couple of ways to think about it. Number one, we've had the best
4,700
two-year return in 75 years. The U.S. equity market has doubled in value from the low of the pandemic. That's a better two-year return than you had coming out of the financial crisis, and it's a better two-year return than you had coming out of the 1974
right now
bear market.
on
So it's
S&P.
been a particularly powerful rally.
So
and
he
the
thinks it's
idea
going
of
to go up
margins
another
at record high levels with all
70
of these
points.
headwinds on
Shit, we're almost there.
Supply chain disruptions, commodity prices,
That's not
labor
that far off
costs,
to be debating.
these challenges have made it harder for a lot of managements to navigate in this environment. But we're not anticipating a recession. So therefore, the history shows, Jonathan, when you are a buyer of the equity market, when it goes down by 10%, and recall we've been down 13% from the high on January 3rd, down 13%, the market typically rallies back to just about the peak of where it was in the next 12 months. So therefore, if 4,800
that's only
was
1.6%.
the high on January 3rd, our forecast of 4,700,
when you convert it to a decibel,
a little bit below that, at the end of
to a
this year, is
percentage.
consistent with what has happened historically. That's not how he arrived
That's not
at the
much.
forecast, but you asked about the conviction.
Bird in the hand
That's
strategy
generally the trajectory
we're
that
implementing
I would
this morning.
anticipate the market kind of haltingly getting towards
Yeah, versus two in the
this
bush.
year. Remember, you'll have a lot of hikes in the near term, but we'll have a midterm elections in November. And when you look at the end of the year,
This
that will
gentleman
then be
talking is
behind
from
us.
Goldman Sachs.
And so looking forward, I think that's the idea.
AKA
That's the
the financial
building blocks
squid.
behind our forecast.
We've got to
Anyways,
talk an earnings season as well.
they're
David, good to
usually right
catch
on
up,
the
buddy. It's
calls.
been too long. Thanks for your time today. David Kostin
I see you.
at Goldman Sachs. Nice to see you too. Coming up, Ukraine's capital still under threat despite Russia's promises to scale back military operations.
Russia has failed in its objective of
Failed.
capturing Kyiv, but they can still inflict massive brutality on the country, including on Kyiv.
And sanctions continuing to pressure Russia's debt payments. That conversation just around the corner.
Stay tuned. Over and out.